Hey guys, Sean here. Now a lot of crazy things has happened over the last few days that is just signaling that things are about to get worse. Now Janet Yellen came out to admit that inflation's out of control, and Jamie Dimon, the king of JP Morgan, is telling us to brace for economic hurricane. Now inflation is high, quantitative tightening is coming, and a world of volatility is really going to hit us like a bullet train. Now Dimon came out saying that we had never had quantitative tightening like this, so you're looking at something that could be writing history books on for 50 years. In other words, it's going to be historic and epic. And that is to the downside, guys, a crash that generations won't forget. Now, I want us to focus on two things for this video: inflation that really can't be controlled by the Fed, and quantitative tightening, right? Because at the end of the day, the Fed only has two tools they can use to fight this inflation problem, and they all revolve around either raising interest rates or the selling of bonds to take money out of the system. And now they're doing both in spades, right? Recently, after all the gaffe, the reputation of the Fed has been destroyed. People are laughing at them every day. No one really believes that they can control inflation. And the Fed themselves have admitted they're doing a pretty bad job at it, right? And now I believe they will go full steam ahead and really unleash a financial hurricane in the process of trying to restore their own broken reputation. Now, let's firstly talk about Janet Yellen and inflation, right? Now, the first thing we need to understand is that the Fed really has a very bad history of overreacting, and as central bankers, I think we can all agree that they have failed miserably, right? Now, in 2021, Yellen and Powell came out saying that inflation was transitory, or it was more or less a non-existent problem. But now Yellen is just like waving the white flag, right? She has finally surrendered. She came out with the lamest excuse in the world. That's just shocking, and she's supposed to be a world-class economist, right? But she couldn't foresee the impacts of money printing. She said that I was wrong about the path that inflation would take. There have been unanticipated and large shocks that have boosted energy and food prices, and supply bottlenecks that have affected our economy badly that I, at the time, didn't fully understand. You know what? She left out the money printing bit, right? I mean, obviously, when you print trillions of dollars, what do you expect? There'll be more money chasing fewer goods. Now, the big issue is that everyone's savings is getting inflated away at a minimum of 8.3%. And I'm being generous here. We all know I'm being generous here. It feels more like 10%, 15%, and even at the gas pumps, it might be even 20% and more. And at first, we were all convinced that the Fed was going to U-turn halfway and, just print more money, pump more liquidity in the system. But it's more and more likely that they will just hike rates all the way to get inflation down to maybe 2% or at the high end 3%, right? Maybe 4%. Now, what they want to do is to really shrink the money supply, the $6 trillion that they created from thin air. So there'll be less money chasing fewer goods. Now, it sounds like a solid plan, but it isn't so straightforward right now. Another part of Dimon's warning is that the Ukraine war and its impact on commodities, including food and fuel, is very significant. And I have to agree, right? He is seeing oil hitting crazy levels of $175 or even above $150. That's going to be quite tragic. And if that happens, it will just unleash chaos, right? Horror will be unleashed on the streets. And he's right, guys. Raising interest rates alone cannot solve the problem with oil and higher fertilizer prices. Now, the thing is, sure, money supply can come down, but the supply of these commodities are also shrinking, so they're at least not keeping pace with demand. So we can really see inflation still be sky high. So right now, we have elevated inflation, but the real threat is quantitative tightening. That is what's freaking the whole market out. And we really need to talk about the risk of quantitative tightening. Now, the Fed has announced that they are going to start selling off their balance sheet, and we're talking about two main assets, guys: the treasuries and MBS, mortgage-backed securities. Now, the big issue with this move is firstly, the Fed will likely overcorrect. They haven't done a thing correctly since 2008, and they have blown up asset bubbles after asset bubbles with their low interest rates and money printing. Just think back to the dot-com bubble, just think back to the 2008 crisis, just think back to 2020. Now, they have created a moral hazard for the whole world and investors with all this cheap money, right? And now suddenly, money is going to be more expensive to borrow and there'll be less of it. Now, this is important because firstly, by selling off treasuries, the Fed is basically going to suck out dollars from the system and they can kind of sell it off pretty quickly, right? There's still strong demand for treasuries because around the world, the delusion is still strong and people still believe that treasuries are a safe haven. Maybe not forever, but for at least now, it still is. And yes, they are sitting at around $330 billion worth of losses, but they don't care. They really don't care. And at the end of the day, if you're American, it's the taxpayers who are on the hook, right? You're on a hook. And the thing is that they don't really care about asset prices. I'm getting more and more convinced that the Fed really doesn't give a damn about the stock market or the price of gold or whatever. What they just want to focus on is the debt market and for inflation to go down. That to me is their number one objective. And here's the thing, by selling off these treasuries, power will really spike the yields up, and suddenly it'll be more and more unattractive to hold bonds, right? Bond prices might really collapse, interest rates on loans could skyrocket, and this is the issue, right? It doesn't just hurt retail customers or all these big hedge funds out there. Companies, everyday companies, small businesses, or the ones that are listed, will kind of find it harder to borrow money to grow. And here's the thing, companies will contract, earnings were slow, and boom, stock prices could suddenly collapse just like that. Now, secondly, by selling off mortgage-backed securities, yes, those are the things that created the financial crisis of '08. Now, this dumping of MBS could really cause the security to drop in price, and now suddenly home loan interest rates will rocket up because of a cascading effect. Now, because there'll still be less money going to the MBS, the banks now have more risk on their books, right? They'll be less willing to loan money out. And this means that homeowners, the mortgage payments and even rentals will start rocketing up. Now, once again, this could crash the housing market because houses are now becoming more unaffordable, right? If interest rates suddenly move from 1%, it goes to 3%, it suddenly flies up to 5%, how many people can really fork out all these monthly payments, especially when wages more or less are stagnant or just increasing slightly? Money will be directed more towards rent and mortgages, and you can just imagine that if you have an entire income pie, right? Let's say, for example, your mortgage used to be 40%, now it's suddenly 50%, 60%, and that's very bad for the economy, right? A lot of your money, you have no choice but to put it into food and shelter, and especially when the shelter portion is increasing, you have less money for other kinds of expenditure. And the risk with all this posturing is that the Fed could very likely overreact and correct to the point of a crash. They really want to hike rates, they really want to take money out of the system all the way down to a 2% interest rate, but something will break along the way. And things are really getting very hairy, and I believe it's key for us to be more defensive than ever with our investments. And that is what I'm doing, right? I'm staying in gold, I'm stacking cash, and I'm stockpiling food. Firstly, let's talk about gold and why I'm buying gold. Alright, so firstly, today almost every asset is imploding, and one of the few winners is gold. If we look at the charts, it is up by 2% when everything else is down 10 to 20%, and this alone tells you something. It tells us that even though interest rates are slowly going up and money is about to leave the system, people are still worried about the overall inflation and believe negative interest rates are here to stay. They just don't believe the Fed can tamp down inflation without breaking the system halfway, and most likely they might come back to save the day with another round of QE. So the thing is that even though I'm quite concerned and I'm quite convinced that the Fed is really going to tighten all the way, the majority of people out there are still kind of believing that the Fed is going to U-turn somewhere down the road. Now, gold has always been a store of value. It's nothing new. It is outside of the financial system, and it really has performed generally strong during the last few stock market crashes, right? Now, we can see that when the stock market crash, it is likely that gold will rise instead of following it all the way to hell. Remember that it either rises in prices or you lose less during the time period, right? Just take a look at the chart. Remember, in cash, you are already losing over 8% in purchasing power by doing absolutely nothing, right? It kind of shows that when people lose faith in paper assets, intangible assets, they rush to time-tested store of value since the ancient Roman days, and that has always been in gold and silver to a small extent, but let's just keep this conversation to gold for now. And since 2008, the Fed has really shown itself to be the helicopter printing money gods, right? They have no other strategy than to lower rates and to print money to solve crisis. Now, during those periods, gold has really actually outperformed the stock market every time the Fed has printed money and when real interest rates are negative. Now, gold rises faster and more violently versus the stock market that lagged behind or even fell during the same period. So here's the deal. Right now, we do not know if the Fed will print money again, but the odds are they probably will if something in the system breaks. Now, the thing is that they have overreacted time and time again, and it's likely that they will lose it and save the economy with easy money or lower rates again if the outcry is really too loud, right? If people are losing their jobs, if unemployment goes up, it is likely the Fed will come in to save the day, and this is a bullish case for gold. And that is why I'm stacking gold. Now, I know Ray Dalio said that cash is trash, but you still need some cash, and maybe this might sound controversial to you, but let me explain. Yes, it really sounds quite silly that you want to stockpile some cash. After all, inflation is really coming for us all, right? But the big issue is that no one can predict how bad the situation can get for the combination of quantitative tightening and higher interest rates. Remember, these two are coming to us at the same time. And the last time the Fed did quantitative tightening or QT was back in 2017, and they only reduced the balance sheet from around $4.5 trillion down to $3.8 trillion. That's around a $700 billion drawdown, and it's not enough to cause liquidity issues back then, and that's why the stock market kept going higher and higher. Remember that at the point of time, the Fed created money from around 900 billion to 4.5 trillion. That's around $3.6 trillion worth of new dollars, and less than 20% of that extra money was pulled out. Now, the Fed is really going to sell up to $95 billion a month this time, worth of assets, worth of treasuries and mortgage-backed securities, and they plan to remove at least 3.3 trillion or more from the extra 4.7 trillion printed or added since 2020. This is what's going to happen in QT2. Now, that is a 70% drawdown or removal of liquidity, and that's very scary. It's never been tested to that degree before. Now, this simply means that in the short term, cash could really gain value across all assets. There'll be fewer dollars chasing the same amount of goods. And yes, this will tamp down inflation, but could also cause a big crash in asset prices. Right now, if we look at the S&P 500, it looks curiously like the stages of a bubble, and it seems that we are at the denial stage or the dead cat bounce, right? If we take a look at the previous bubble or the psychology of a market bubble, it's beginning to look curiously like the chart of the S&P today. Now, it looks like things are picking up. S&P is having quite a bit of a dead cat bounce. People are beating the markets up again, but it's probably just balancing on a stool, and the trajectory most likely is still gonna go down. And this QT, this quantitative tightening, could be enough to just finish the market off. Now, things across the board will get cheaper, and this represents a real opportunity for us to get richer, right? Money doesn't just disappear, it transfers from one asset to another. And that means that we can take advantage of buying assets at a sale. Everything will be on sale, most likely. We're talking about stocks, cryptos, if you're into that, and even gold and silver could fall by quite a bit. Now, how far it falls, we don't know, because in the past, every time the markets were crashing back in 2008 and 2020, the Fed had stepped in to save the day. Now, remember that inflation is still high and essentials like food is still expensive, so this process can be worsened if households in America or across the world who all hold a lot of US equities decide to liquidate their holdings for cash to buy their daily necessities, right? So this is what I like to do. We have to watch the 10-year yield. I personally keep track on the 10-year yield like a hawk to see how money is really flowing, because if it suddenly keeps spiking as a result of rising rates, it means that people are exiting bonds and they are staying in cash. And the thing is that this cash can then move into other assets like maybe gold or stocks. But if the yield gets too high, then it's also bearish for stocks, because now borrowing money to grow is suddenly becoming more expensive, and that could really trigger a massive crash as well. And lastly guys, you need to be stacking some food as well. I'm filling up my fridge to the brim, and it's all to do with the last part of Jamie Dimon's warning about how oil could hit $150 or $175 a barrel, and that is a real concern, and it's not just for energy prices but food as well. Now, the head of the IMF came out with a warning that food prices is going to soar, and she said food prices are going to continue to go up, up and up, which is rather obvious. But she also mentioned something that we can't deny, right? That we can shrink the use of petrol when growth slows down, we can cut down on gasoline, but we have to eat every day. The anxiety about access to food at a reasonable price globally is hitting the roof. Now, the problem is twofold, right? We're talking about fertilizer costs and protectionism. Now, let's talk about fertilizer costs because these costs are skyrocketing. Fertilizer needs oil, and higher oil prices will just cause the prices to soar. Now, food needs to be grown, and that means food that's planted today with higher fertilizer costs will be priced higher down the road, right? So just because right now food prices seems to be stable, if fertilizer cost starts to go up, that means down the road, you're talking about 3 months, 6 months, or even a year, we could actually see food prices rise again. Now, secondly, we have to talk about protectionism. And this is about countries protecting themselves for their own interest, right? And this is the big problem with globalization today that's happening. Countries are getting really too specialized in what they do. For example, if you're Japan, you are the king of manufacturing and technology and innovation, but you don't really grow a lot of your own food. You import energy and you import food as well. And this is bad for all the countries that are too reliant outside. Countries that import food, right? I mean, countries that are exporting food, they're really saving it for themselves. Protectionism is really happening today. We are seeing India restricting grain imports. China seems to be hoarding food as well. Indonesia recently banned palm oil exports, and even Malaysia stopped exporting chicken to Singapore, where I live, and chicken prices are really exploding through the roof. Now, things are soaring, and that means we really need to prepare ahead. I'm experiencing food vendors, restaurants, cafes. They are really jacking up prices by around 10 to 20% at least, and I'm sure more or less it's around there for you as well. So this is what we need to do. We need to stack food and prepare for what's coming. And the key here is to really fight for your survival, because if you can't get through this phase, right? If you can't survive, then there's no point talking about stocks, there's no point talking about gold, and who really cares about real estate at that point? Now, there are two things you can do, which is to stockpile emergency food and your non-perishables, like canned beans or maybe pasta, because food prices will likely continue to rise. And just tell me honestly, right? How often do you find food prices going down year after year? You don't really find it, right? Now, secondly, don't just stop at buying food. It's time to grow your own produce. And we're talking about the simplest ones that even I'm beginning to try out myself, including onions, tomatoes, and lettuce. You don't really need a big farm. If you're living in a condominium apartment, you can just use the balcony out there, right? You don't really need to be like Ronald McDonald's, old McDonald with a goddamn big farm. You can just do it in the comfort of your home. And the great thing about homegrown food is that you don't need to pay for fuel costs, and you avoid jacked up prices thanks to shortage. So for example, let's say there's an onion or tomato shortage, you grow it at home, you don't need to pay that additional amount of money, and you'll live a much healthier lifestyle to boot as well. Now, thirdly, don't just stop at food as well. A lot of things will go up, including your toiletries. So stack toilet paper, stack toothpaste, soap, and shampoo. You really want to be resilient during this storm. You want to survive, focus on survival first, then you can build wealth down the road. And we need to understand that we are in some of the most uncertain times in history, and there's really enormous downward pressure everywhere for prices to really crash. And I'm talking about a really big crash. And the most important thing for us is to focus not on getting rich during this period, because chances are everyone's portfolio will be likely in the red. I have some things that are up, but most of my portfolio when it comes to equities are actually down as well. And the key here is to really survive and lose less, because if you do that, you'll live to fight another day. Now, if you have floating rate debt, right, it's important to get rid of it as soon as possible, because your payments will undoubtedly go up down the road. And being defensive today is essential, and there's a very good saying about not fighting the Fed, because the Fed can print as much money as they want, and they can sell as many assets as they want. They can pull out as much money as they want, right? They have deeper pockets and authority than you or I. And the thing is that if they start printing money, we can ride the wave up, but now they are pulling out money from the system. And what we want to do is to be careful and to be conservative. Now, personally, I believe in accumulating assets all the way down. But if you're following this path, you need to be dollar cost averaging and not YOLOing your money into one single trade like a hero. Because right now, what it seems that the markets are rebounding in the short term, it is likely a dead cat bounce and things could really turn south very, very fast. Remember that the market climbs a wall of worry up but takes the elevator down. Fear is more powerful than hope. But should you really stay out of the markets 100%? Honestly, it's hard to say. I don't have an answer, I'm not clairvoyant, because there's always the chance that the Fed could come in, do a U-turn and flood the market with cheap money while lowering rates again. And considering the Fed is such a bipolar central bank, it is definitely possible. So let me know what you think in the comments below, and if you enjoyed today's video, be sure to smash the like button and subscribe for more videos. Thank you all for watching, and I'll see you soon.